Today we're going to go over some examples of the weekly market maker template. Stay tuned, traders. We'll be right back. Good day, traders. I'm Stacey Burke from Stacey Burke Trading. Hopefully everybody had a reasonably good trading week last week. We had a lot of volatility. There's all kinds of stuff happening in world markets this past week with scares over the coronavirus and market jitters, but as we saw in the currency markets, as they do every week, they moved, and they moved quite a bit. Today we're going to go over some examples of the weekly market maker template, smart money, institutional money, whatever you want to call it. We're going to go over some examples of the up and down templates, some of the variations that will evolve, and as you're finding out in live time, if you keep peeling back the onion, even though we have a really simple model that we approach the market with, that simple model has a whole world within each structure. In number one, protecting us, hopefully keeping us out of traps, keeping us from losing money, and hopefully positioning us for the best times and opportunities for the best reward on our trade risk. So today we're going to go over a basic example, but we're going to talk about some of the variations that you're going to encounter, and then also how to interpret that in live time. Remember, we talked about not trying to trade every single move in the market, starting to identify a couple of key simple setups that show up very frequently, and how we can profit from those trade setups, and then learn to master those setups, and then scale them up and trade them bigger and bigger and bigger. So I've just drawn an example of a typical weekly template. Now, you know, we talk about if this was Monday, and I call Monday day 1, Tuesday day 2, Wednesday day 3, Thursday day 4, and of course Friday day 5. I've used a simple example of an up template where we see 3 levels of rise, and then that volatile level 3 where the market then shifts and goes sideways and then drops down into the reverse of what we saw in the up leg. Typically, this market will look something like a head and shoulders sort of pattern. Now, what you're going to come across in live time is that there are subtle variations that will present where this could actually be a Thursday and a Friday, and we come into Monday, and Monday continues this into Tuesday, Wednesday. You might find that the market might actually have come off of a big uptrend, and they might actually put 3 of these together over the course of 3 weeks, which is where we'll see trend lines. You might see where the market will be in an uptrend, and in a particular week they might work a level 3 times over the course of a week before reversing on a Friday. There's subtle variations, but the one question you want to keep asking yourself each day and as the week evolves, a couple of questions. Are they attacking the low when they come out of the Asian session? Are they attacking the high of the week repeatedly but not going any higher? Or are they coming off of the high of the week and then attacking the low consecutively? There are a lot of little variations and traps that they will try to throw at you, and we're going to go through some of those in the examples. But number one, we talk about identifying our Asian range. We talk about trying to work from the highs and lows, and if you've been following the last few weeks, you know, the last video we talked about the volatility that had already started early in Asia while I was doing the video. And as Friday unfolded, there was, even though it had already moved 250 pips by the time that the London market opened, there was 150 pips of movement down, and 150 pips movement back up, and another 150 pips movement back down on a couple of the pairs. So it's important to understand that no matter what they throw at you in Asia, and sometimes when you think you've missed the trade, you have to ask yourself the question, are they trying to get me up top? Even in the intraday session itself, you can see
an Asian box that takes on this characteristics, and then a London box, and then the New York reversal, and the shift into the close. This same template will show up in a fractal level, even down on the 1-minute charts. So it's important. We're going to go through some examples, and I'm going to encourage you to go back through your own charts and start to identify these cycles. And you'll be amazed that when Monday comes along, even though you might be in the middle of a weekly template that's already halfway through, you're going to see that day one still has precedent. And we're going to talk about some things later on in a different video about the importance of Monday's high and low, and how you can use that to extrapolate out profit targets or range-bound markets when Monday, Tuesday, if Tuesday expands on that range. But for right now, we want to get the basic concept down that there is an agenda in place, and largely that's designed in a lot of cases to drag technicals in one direction over the course of 2 to 3 days, which in this particular situation, in an up template, that triggers traders, retail, maybe small funds, private traders. By this point, they're convinced that this is a trending market, and it forces the market to participate by buying high. So if they're trying to sell off to make money, they need to build up that volume at higher and higher prices to unload it, which is why typically at level 3, we'll see the market come out of the Asian range in the direction of the trend. In some cases, it looks so easy to participate in, and there isn't a stop hunt out of the Asian range. Traders they take that trade into the trend. It doesn't go much further than possibly 25 to 50 pips. And in most cases, probably only the next 25 pip increment above the box. But it will come back and not allow you to get out at break even in a lot of cases. It might hit again higher. It doesn't come back and stop you out, but it doesn't allow you to take much off the table. And it hits it a third time before shifting. Now, I've mentioned that level 3 is very common, and you can go back and check this on your own calendar when we have the Fed. And then going into Thursday, which we saw last week, we saw this Monday on the pound yen. We saw level 4 behavior where the market consolidates, and we call this a straightaway trade, where it comes out of the Asian range and it doesn't give traders a chance to participate in this move, and it can often be 50 to 100 pips or more. And then it's possible to have a second day continuation of that on the Friday, which we saw on the GY, the pound yen, but in some cases they will stop on high. This can occur on a payrolls Friday, for example. If the market has put this peak formation in place, the payrolls wick may come up and stop out traders that have gotten in on that leg. There's a ton of variations. This could be a Monday, Tuesday. It's not uncommon to see a Friday, Monday, or a Friday, Monday in that situation. So we're going to go through some examples now, but the one thing I'm going to encourage you to do is to scroll your charts, tighten them up, put your weekly separator on there, identify some of these templates, and then expand that out and go back with your boxes, your Asian range, and look at how the market traded throughout that template and how that matched up with our market timings, our 50s and double zeros, the stop hunt, 25 above or below, and how you would have traded that in terms of an engulfment perhaps, or some pin hammers. Often what you'll see, which will end these templates, even in the intraday cycle, are a W formation down low and an M formation up top. And even in the intraday sessions between London and New York, or Asia and New York, or the high and the low and the close, you will often see this end the daily session as well. Not only a weekly session, but a daily session. And we're going to go through some examples of that. But this week, we saw a week ago Friday, the GY put a beautiful M formation in place on the Friday. Again, we went into level 1 trade, a level 1 straightaway out of there on day Monday. But we're going to go through and just show some of the subtle variations. It's important that you can start to understand there's a bigger picture about working from the high and the low as the week unfolds. And rather than just trying to trade each move out of Asia or anything like that, start stepping back. We talk about the importance of the high and the low of the week, and the pound New Zealand and the pound Australian were great examples of that this week, where they literally went from the high of the week down to the low of the week 3 times. And that's a big range on some of those pairs as the week unfolds. So again, we talk about risk reward. If you're trading off the high and you're targeting maybe 10, 15 times your risk, that's possibly a great trade opportunity. And in the next couple videos, we're going to go over some of my best playbook setups, which when we see them present off of these formations, how we can identify not only about getting into the trade, but how to possibly participate with a tight stop and maximize the trade itself for as much as we can squeeze out of it. So let's take some look at some examples now.
For some of our examples now on the up template, and again, I encourage you to go back, squeeze your charts together, and then when you can identify these 3 levels of rise and a peak formation and the sideways movement and then the straightaway back down to the low, go and open those charts up and see how you would have applied your system, your 12 candle rule, your timings, all of those things, your 25 pip boxes, to how these templates unfolded. This is a Thursday, Friday, and a Monday defined by that pink line again. You can see we went into a peak formation. Level 3 comes out in the direction of the trend, and then we have that volatile up and down movement before they go sideways underneath of the peak, and then come out of that strongly towards the bottom of that range. Another example on the pound USD, a Monday again. Market made a W on the Friday, stop hunted low on the Monday, and this is an example of where they went up 3 levels in one day and made an intersession level 3 going into Wednesday, and then the straightaway trade back down to the low, stop hunt high, again down underneath the weekly low, sideways. Whenever the market goes sideways underneath of a level, pay particular attention to how they attack either the opposite side of the range, or if they come out of that range aggressively towards the numbers. In this particular case, they came off of double zeros. We're going to talk more about measured movements later. You can see that this market did a range expansion of the other previous level above it. But again, the concept, W, level 1, level 2, level 3 on the Friday. They dropped it down on Monday, made another W inside of this, stop hunting the London breakout. 3 levels of rise intraday for the level 3 trade, then down straight away in level 4, and then level 5 on the Friday. Thursday, Friday. Again, pound yen, this was in January. The market forms its 3 levels, goes into the volatility on level 3 that is common with level 3, into Monday. This was a Friday again, into Monday sideways, and then aggressively moving back down to the low. On the Tuesday morning, comes up 50, almost 75 pips before it stop hunts the low of the week again and comes out of that area aggressively. We talk about the importance of the low and the high of the week as it unfolds. And again, you can see that this market went up level 1, level 2, level 3, peak formation straight out of there, and then the next day sideways for the level 1 underneath of the peak formation. So if you see a market move vertical, go sideways and come out of that market vertical, the next day, in most cases, look for this tight consolidation. And again, we had this straightaway trade out of that range going into Friday for the return back down towards where that market opened up at on the Tuesday. Again, that template, that's the sort of template we're looking for. We want to be able to identify, are we in an up template? And if you are trading long, that's fine as well. But as we get up to this level 3, we're also considering the opportunities that can present with a consolidated market for a straightaway trade back down to the low of the week. Again, another example on the pound yen in December. Monday, Tuesday, and then aggressively moves for a measured movement up 3 levels of rise into that level 3 behavior, and then sideways into the next session for the straightaway, and Friday continued that for a second day trade. We're going to talk about the down templates in the next video, but you can see going into Friday how this created a 3-day down template. Friday formed the first shoulder of the upside down head and shoulders. Monday was a peak formation. They dragged traders down low, dragged them down low 3 times, didn't break the level, and then reversed out of there quickly and went into a peak formation where we see the opposite template again. Peak formation, level 3, drops down below that last high, the last low before the high, goes sideways, straight away back down to where that move began. So in the course of a week and a half, we see an up template, a down template, and another up template. So it doesn't necessarily have to evolve over 5 days. It can happen between 3 days. It can happen in 2 days. These are the things you want to look for. Another example, this was the election. After the election results, the market opened on 150 pip gap. And again, when anything goes vertical for that distance, it's not sustainable. We're going to talk a little bit more later about some of the average daily ranges and the importance of the rules that to some degree need to be adhered to Monday to Friday. And so again, we had the level 3 formation, 3 pushes to the high before it drops down, consolidates, works the low, comes back into the next day where we expect to be some sort of consolidation. This was a 100 pip consolidation, and the market did a measured move down, went sideways into that lower level before continuing that move down. Another example on the pound yen from October. Again, here's our Monday. We see our W formation from the week previous, and that consolidation occur over 2 days. Monday stop hunting low, and then Tuesday morning coming up, consolidating, going into a peak formation on Tuesday, Wednesday. Wednesday going sideways, straight away down, reversing all the way back down to the low of the W. And then the market went into a range-bound distribution over the next day and a half before working the low and forming a down template. This is an example of an up template that occurred over 3 weeks. So a peak formation was put in place, went up over the course of that week. The second week it continued that move up, and then the third week we see that level 3 behavior where the market has come out of the bottom of the range with the trend and worked the high 3 times before dropping down and consolidating over the next few days and dropping down another level. So again, this could be 3 hours, this could be 3 days, it can be 3 weeks, and on your daily charts you'll see 3 months of similar patterns. And when they come out of level 3, there can be some massive opportunities if you combined a daily level 3 with over the course of 3 months with a Monday to Friday template coming out of the Asian range at the right time, at the right levels to participate potentially in a move that could be possibly 40 or 50 times your risk. Just something to consider. This is the pound Swiss in October. Just again another variation. The market came down and made a very strong move down on Monday before reversing into Tuesday. They stop hunted low. So again, asking yourself the question, which side of the market is the smart money working? It's working the lows, and then it shifts. We expect to see a trade that comes in the direction of the trend to possibly be the beginning of level 3 type behavior. The market didn't consolidate underneath. It consolidated within the range of that level, what we suspected might have been a level 3. but then the market comes back up into Thursday to give us our level 3 setup before dropping down, and Friday forming our W formation. Sorry, this is Monday, forming our W formation to continue that move back up. This is the pound Swiss in November. We saw a very similar setup this week in the pound Swiss. The market opened on Monday and worked up into the high, came down, consolidated, it worked the high again at numbers, came down and gave us a possible peak formation underneath of a peak formation, consolidated. We're expecting straightaway. The market works to the opposite side and hits this upper level for the third time within the week before shifting down. The next day again it works up, but it's dropped down almost 50 pips, consolidated into Friday before giving us the beginning of what could be a very large straightaway trade down. So again, going back, looking at these charts, identifying where's the market been working. So on the next day we look and we say the market possibly has put a peak formation in place up top, but then they come out of the Asian range and work the high of the day. So again, this may have been a New York sell opportunity up here. We expect the same thing the next day for a short. It doesn't. It comes out of the Asian range and attacks the high. Again, another New York sell. Same thing on day 4. This is getting really tough, but they're working lower again, down lower, 50 pips down. And then Friday, we get a consolidation that although it works upwards it comes out of the Asian range down, it works the high of the day, and again possibly gives us a New York sell. Just looking at the date, I'm assuming this was a payrolls Friday as well. So again, an example of an extended trend where different templates can form inside of an uptrend. The market consolidates and keeps working the high. We think this potentially could be level 3, but the market doesn't come underneath and go sideways. It comes up again, working the high, gives us our M pattern. We're expecting possible straightaway the next day. We trade this. We could have been short, but the market jams into the double zeros on a W formation before reversing. This is a Friday, and this is what we would call a reset, a possible reset. The next day, the market stays consolidated in a 25 pip range. This is very common when the market is going to continue its move. It has a reset for a low of the week formation, goes into a consolidation before continuing that move of the previous week. And in a lot of cases, it will do a measured move of the week that it's just come out of. And as you can see, this market had a very strong move up. Again, a peak formation gets put in place. This is a Thursday. The market comes up on the Friday, works up very aggressively before consolidating on Monday into a range, almost a range-bound market. Tuesday, again, breaks high before stop hunting low and then hitting the high 3 times. We think this is possibly a level 3. Market consolidates, gives us a possible straightaway entry, but reverses off the double zeros, comes up and works the high one more time and puts in place what possibly could be our peak formation. Then stays underneath of our last low before the high, rolls over and gives us our straightaway trade back down. So again, sometimes you're going to see something that looks textbook perfect and it doesn't unfold the way that you expect, and you're going to say this doesn't work. Well, they can do whatever they want, whenever they want, and that's one of the things about putting your live performance together with your knowledge and applying it with a skill set, not in a hope mentality, but I'm going to execute based on how their hand unfolds. And sometimes you're going to be in a trade down, you're going to go to break even, it's going to come back and stop you out, you're going to get frustrated, but you have to step back in the game. Tell yourself, we work from the high and the low. This market gave us a peak formation before coming down and consolidating underneath of that peak as well as the middle of that M, and dropped down to give us possibly not only the entry up here, but a New York entry as well for over 100 pip move down. This is an example on the pound New Zealand. Again, this is almost a textbook perfect template. What I wanted to point out here is that this is a Friday, Thursday, Wednesday, and that peak formation was put in place over 2 days between Friday and Monday. And you can see that Monday opened on a gap that gave us the middle of the M structure before working that high, 1 push, 2 push, 3 pushes, and dropping down into the close of Asia. And this is typical with a straightaway trade when the London market opens and continues that move down with only one candle. These are if you're not seeing this in live time, they're very hard to participate in, because the market will not give you a chance to get into this trade if you miss the move. Another example from the pound New Zealand. So again, our Monday bar, this is a Wednesday, Thursday, Friday. The market dragged traders up high on the Tuesday before working the low 3 times. That's a 200 pip move down, and then reversing off of that 3 thrust pattern, giving us a new W and possibly a reset for a new template up, which again, as that unfolded, we saw the stop hunt low, consolidation, and then a level 3 M pattern form up top. So again, the basic template, 3 levels of rise. The most important concept I want you to grasp out of this is this 3 levels of rise: ghost and mittens, head and shoulders, whatever you want to call it. You're going to see these templates over and over and over again. And this M formation, this level 1 straightaway trade, look at the different variations, the W's, the consolidations. You're going to see this over and over again. How could you have profited from those trades? How could you have participated in those trades when they came? If you're down and you see that this is possibly going to continue the move down, you want to be thinking sell high, sell high. If the market doesn't give you a sell high, doesn't mean you can't trade in both directions, but you want to be careful, especially on level 1, trying to trade against the peak formation. These markets are going to move. If you were long in this area, traders held on to it, they're potentially in front of a straightaway trade. So it's really important, again, to identify as the week unfolds. If you're part of a multi-day pattern that's unfolding from the previous week or the previous 2 weeks, are you in a trend? Are you in a range-bound market? Or do we already have our peak formations in place, and could I be in level 2 or am I in a level 3 trade? These level 1 trades are the best trades in terms of the potential range that they may go after. And again, when you're coming out of a level 3 on either side, you definitely do not want to be counter trending back into that peak formation. You could be standing in front of a move that could go 2 to 3 days against you, and in this case, that's a 300 pip move. So we're going to go through a couple of examples now of what you can do to go back and identify how you could trade this better in live time. The pound USD, we just got an example of a long template. So again, you can scrunch your charts up, go back, look for some of these templates that you can identify. So we have a Monday here. Monday, Tuesday, Wednesday, Thursday, Friday gave us our peak formation over 2 days. Monday, sideways, and then straight away. Tuesday, Wednesday, continuation, stop hunt high. Friday, Thursday, and then down into a capitulation type move into the Friday, Monday. But what's important about this is to go back now and possibly break this chart down into its smaller time frame increments and looking at how possibly that week unfolded in live time and how you potentially may have traded that bar by bar at our session changeovers. What type of candle formations? Was there anything in the London session that gave us an ideal opportunity or information that told us we would want to be buying or selling? New York Open, they dragged traders up higher and higher. We were thinking this could be level 3, but they've taken out the high. Tuesday, they go sideways, and this is typical. They stop hunt the low of the week and give us a new W formation for a possible reset. Takes out the high of the week, goes higher, consolidates into Wednesday. We were thinking this could be a level 1 trade setup. Market stop hunts out of the box in the direction of the peak formation, and again comes down, doesn't doesn't take out the overall low from the US session, continues that move up on the Thursday. Possible level 3, comes down, consolidates, but then on the Friday goes after the peak, but it does not take out the overall high. So again, traders were dragged up early in Asia. This is a typical 1, 2, 3 pattern on the end of a distribution box at the high before it dropped down and went sideways into Monday's open. So again, go back, look at the timings, look at your high and low of Asia range, look at your highs and lows of the week, look at how you would have traded this in live time. Most importantly, again, selling high in a down template at the session changeovers. Okay, if there's nothing coming out of London or nothing that matches your criteria, start thinking New York. We're going to talk about the 7 o'clock stop hunt in the next few videos, but the importance again of if you're in a down, an up template for a sell, you want to be selling high, or in a down template buying low. So hopefully you got some value out of today's video, traders. Identifying the up template, looking and recognizing when a level 1 trade presents, how to participate in that move, never counter trending the peak formation in a level 1. The main reason being you could be dragged into a trade in the wrong direction for 2 to 3 days, especially if you ever lift your stop. Do not ever lift your stop. Don't use a stop. Whatever you do, tight, your risk should be tight. You can see when you're wrong on these trades, not only are you wrong, it keeps moving against you. And one of the driving mechanisms behind these templates is by the third level, all the technicals are screaming trend trade. So everybody piles on board and buyers get caught up high. If they're selling, they get caught down low and they get dragged in the opposite direction for massive, massive losses. These are the type of trades that will blow out your account if you're trading in the wrong direction. But most importantly, go back, scrunch your charts up, identify these templates, look at the weekly cycles, start paying particular attention to the high and the low of the week. These M's and W formations, they show up everywhere. Trade smart, stay disciplined. We're going to see one of these templates this week. So hopefully you got some value out of today's video, traders, and may the markets go with you.
Hi traders, it's Stacey Burke from Stacey Burke Trading. If you haven't done so, please head over to my website at staceyburktrading.com. I create updates on almost a daily basis and I would love for you to receive them. Just click on the blog. If you want to enter your name and your email address, I'll send you my free audio program, the 7-Step Daily Routine for High Performance Traders. This is essential knowledge for all traders in all markets, and this is for helping traders to master the market with discipline, confidence, and a winning mindset. I appreciate all your feedback and comments. As always, traders, stay disciplined and may the markets go with you.